One narrow strip of water can influence the price of fuel, food, air travel, and almost everything transported across the global economy. The Strait of Hormuz is not simply a shipping route, it is one of the most dangerous pressure points in the entire world economy. At the mouth of the Persian Gulf, the Iranian coastline to the north and the rugged Musandam Peninsula of Oman to the south form a physical vice. This is the geographic reality of the Strait of Hormuz. At its absolute narrowest point, the waterway spans just 21 miles from shore to shore, yet the actual space available for heavy commercial shipping is far smaller. Navigation hazards and islands compress the active traffic into two precise channels. Outbound laden tankers must stick to a corridor only 2 miles wide. Inbound empty ships travel through a parallel 2-mile lane, separated by a 2-mile wide buffer zone. Despite this extreme horizontal compression, the passage drops to depths exceeding 60 meters, sufficient to accommodate the fully laden draft of the largest supertankers and liquefied natural gas carriers in existence. This physical profile creates an uncompromising bottleneck. For the major energy exporting nations bordering the Persian Gulf, Saudi Arabia, Iraq, Kuwait, the United Arab Emirates, Qatar, and Bahrain, there is no alternative maritime exit. Every vessel departing their terminals has no choice but to transit this single, tightly guarded gateway, making physical geography the ultimate gatekeeper of the region's wealth. What actually passes through these narrow lanes is the industrial lifeblood of the modern world. Every day, the global economy relies on 5 distinct categories of cargo moving through the strait, each tied directly to the cost of living for billions of people. First is crude oil. Before the current disruption, data from the U.S. Energy Information Administration in 2024 showed that approximately 20 million barrels of oil-related cargo transited the waterway daily. This massive volume represents nearly 1/5 of global consumption, directly dictating prices at local gas pumps and the shipping costs of everyday consumer goods. Second is liquefied natural gas, or LNG. The Energy Information Administration reported in 2024 that roughly 20% of global LNG trade relies on this single passage. This gas fuels power grids and home heating systems, with 83% of the shipments bound for major Asian markets. Third is refined petroleum products, including jet fuel. Disruption here immediately raises airline ticket prices and drives up the operational costs of global logistics. Fourth is ammonia, an essential chemical building block. Data from Rystad Energy in 2025 indicates that 15% of the global ammonia trade flows through the strait. Fifth is urea, a high-nitrogen fertilizer. Rystad Energy's 2025 assessment shows that 21% of global urea trade passes through these waters. Without these two agricultural commodities, fertilizer production drops, translating directly into higher food prices and grocery bills. These essential commodities flow predominantly to a select group of highly dependent nations. East Asian economic giants, specifically China, India, Japan, and South Korea, absorb the vast majority of these energy and agricultural shipments, tying their industrial production and household food costs directly to the safety of this single waterway. Circumventing this choke point requires infrastructure that simply does not exist at scale. While alternative routes exist, they function as partial relief valves rather than true replacements. Only Saudi Arabia and the United Arab Emirates possess significant built-in bypass capacity. The Saudi East-West pipeline can transport approximately 7 million barrels of crude per day to the Red Sea, while the United Arab Emirates Habshan-Fujairah line can redirect roughly 2 million barrels per day directly to the Gulf of Oman. For these two nations, a partial detour is possible, but for Iraq, Kuwait, Qatar, and Bahrain, no such land-based alternatives exist. Further downstream, the Suez Canal and the Sumid pipeline in Egypt offer secondary routing, but they operate near capacity and cannot absorb the massive daily volumes of a fully closed strait. The only remaining physical option is the long maritime detour around the Cape of Good Hope. This route bypasses the Middle East entirely but adds 20 to 22 days to voyages, inflating shipping times and fuel costs. The global energy network has safety valves, but it lacks a substitute. A halt in shipping can occur through multiple pathways without the strait ever being physically sealed. Historically, regional conflicts have repeatedly shaken markets long before any total closure. The 1973 embargo showed how market sensitivities react to supply shocks. During the 1980s tanker war, direct attacks on merchant vessels forced the United States to launch Operation Earnest Will, deploying naval escorts to alter shipping behavior. The 1990 Gulf War caused severe price reverberations, while the 2019 to 2021 Gulf of Oman incidents exposed modern asymmetric maritime risk from mines and drones. Today, the threat of regional escalation can trigger commercial fear. If the Lloyd's Joint War Committee increases war risk premiums or insurers withdraw coverage entirely, shipping companies will voluntarily suspend operations. At the same time, strikes on coastal ports, loading terminals, and refineries can choke off exports at the source, halting trade even if the waterway itself remains completely clear. Commercial anxiety alone has the power to paralyze global trade long before a physical blockade is ever established. In a hypothetical scenario where shipping through the strait is reduced by 25%, the immediate loss of 3.6 million barrels of oil per day triggers a systemic economic shock wave. According to modeling by the Federal Reserve Bank of Dallas in 2026, this conditional supply deficit would raise Brent crude prices by roughly $7 to $10 per barrel. This energy spike immediately passes through to consumers, raising fuel prices at local gas stations and increasing operating expenses for commercial trucking networks and passenger airlines. As transport costs climb, industrial factories face more expensive raw materials, higher manufacturing inputs, and rising electricity rates. At the same time, agricultural supply chains feel the pressure. Because key fertilizer components rely on this corridor, farming inputs spike, which ultimately drives up food prices at the grocery store. The final wave of this chain reaction hits the broader macroeconomic environment. Under this hypothetical disruption, modeling from the Organization for Economic Cooperation and Development in 2026 indicates that global consumer price inflation would rise by 0.3 to 0.5 percentage points, while overall global GDP growth would be reduced by 0.2 to 0.4 percentage points. The consequences of a disrupted strait carve an uneven path across the globe. Gulf exporters face immediate fiscal stress as stranded oil halts national revenues. East Asian economies, particularly Japan, South Korea, and India, sustain the most direct hit, bearing rapid import cost spikes due to their near-total reliance on Gulf flows. Across the Atlantic, the United States and Europe absorb the shock differently. While the United States imports only a tiny fraction of its oil through the corridor, its domestic fuel prices remain anchored to global benchmarks, leaving consumers facing immediate price hikes at the pump. Europe faces acute supply pain in specific sectors, especially aviation, because it relies on the strait for nearly half of its imported jet fuel. Meanwhile, the most severe humanitarian burden falls on lower-income, energy-importing nations, where rising fertilizer costs instantly translate into food crises. To counter a systemic energy crisis, reserve managers and governments rely on a pre-established emergency toolkit. Strategic petroleum reserves offer the first line of defense. The United States holds roughly 600 million barrels in its reserve, while China maintains a stock of approximately 300 million barrels. Under a coordinated International Energy Agency agreement, member states can tap a collective pool of roughly 1 billion barrels, bound by a 30-day emergency sharing commitment. Japan and India hold further vital yet finite buffers, but these stockpiles only cushion short-term price spikes. Incremental production from alternative global producers requires significant lead times, while demand reduction and maritime rerouting merely slow the shock without eliminating it. For global markets, mitigation is not replacement. In an era of shifting alliances, this narrow corridor remains an irreplaceable artery. Our globalized world has built immense complexity on top of fragile geography, leaving modern prosperity anchored to 21 miles of water. This is Dark Atlas, where geography explains power.